Let me first thank you, SET, for hosting us and giving us the opportunity to speak today. And also, please accept my apologies for speaking in English, but I don't think you want to hear my Thai. So my name is Cedric. I'm working at MSCI, and I'm leading our ESG and climate business in South Asia. And I will be speaking about why ESG matter for the future of investing. I thought I would start with just an introduction of who we are. So we are the leading provider in terms of ESG and climate. We are supporting more than 3,000 investors globally across their requirements to integrate ESG and climate into their investment and risk process. We also support a range of ESG and climate equities and fixed income indices that are supporting a number of, obviously, ESG and climate ETF. We're working with all types of investors, right, in terms of buy-side asset managers within their investment and risk functions, but also supporting pension funds, insurances, consultants, as well as central banks in terms of integrating all of this, again, in terms of inside their processes, but also in terms of asset allocations. Then obviously wealth managers, OCIO fees, advisors, fund selections, and then finally on the sell side, banks, including corporate strategies, sustainable finance, but also in terms of their lending practices. So as you would gather, right, our bread and butter and really our key core clients are institutional investors. That means that we are an independent provider of ESG and climate data. We do not provide any solicited ratings, unlike credit rating agencies. And we also do not provide any advisory services. And I think that's quite important, right? We have to be independent. We have to avoid any conflict of interest. But again, right, so you cannot come to me, tell me, Cedric, I've got these types of programs and policies. Can you guarantee that I will get an upgrade? We do not do this, right? The way we work with corporates are we collect publicly available data, right? And then corporates that we analyze can have access to that data on a dedicated corporate portal where they can check that data, they can correct the data, and they can also engage with a dedicated team called the Issuer Communications team, where they can ask questions around their methodology. And I thought I would share with you some stats around what we see in Thailand, right? And then I think that's also thanks to the great work that the SET is leading here, as well as various different stakeholders, including the IMC, right? Where we see really over the last 5 years an increase in terms of engagement with Thai companies that is really similar to what we're seeing in terms of other global markets across developed and emerging markets. And really, I think what is interesting is that you see that the rate of engagement that we're seeing in Thailand is actually greater than other emerging market economies, which I thought was quite good to highlight. So before diving into why ESG matters, right, I think it's good to go back into the bases, and hopefully I will not contradict what my fellow speaker previously I shared with you, right? So I hope you will excuse me if there is some overlap or contradictions, but I'm up for debate. But clearly what we saw, and then I'm sure you're aware, and that's why we're talking today, right, is that there's really a flow of money into ESG in terms of AUM, but also when we look at public ETF, right? The reason is obviously, so there's a change in terms of the investor base, but I will spend today a bit more time in terms of the understanding on the correlation between ESG risks and performance, then speak a bit about what we see in terms of the push from regulators in terms of pushing for transparency, and then what it means in terms of new issues that are appearing when we're talking about ESG. So when we're talking about ESG, right, I think it's good to go back into what investors understand, right, and what their motivations are. So there are 3 buckets. You've got the regulations, you've got the restrictions that they may have, right? So for instance, you've got obviously the EU regulation, the Sustainable Finance Disclosure Directive, the SFDR, the Sustainable Finance Disclosure Requirements. Or you may have investors that do not want to invest in specific activities, right? So they would exclude, let's say, tobacco, alcohol, etc., right? That's one bucket. The second bucket is about climate risks, right? So especially if you've got entities that set up some net zero requirements to decarbonize their portfolio, but also integrating climate risk within their process. And then the last bucket is all around ESG risks, right? So looking at ESG as a factor that may impact the financial performance of a security of an issuer, right? So if you think of water stress, how water stress as a key issue may impact, let's say, a mining company. And this is one of my favorite slides because I think it really highlights also what various investors look at ESG and the different factors that they may be looking at, right? So obviously we all know Tesla, right? And so if you look at it from an ESG risk angle, so it's being a single A rated under our MSCI framework, which means that it's kind of middle of the road. And reason being is that, yes, it's well placed in terms of the environmental pillar, in terms of exposure to clean tech. It's well positioned in terms of governance practices compared to its peers. However, it's a single A rated, notably because of the score it gets on the social side, right? And so in terms of, I'm sure you're aware, in terms of labor management issues, notably, as well as product quality. So that's on the risk side, but then many investors nowadays are also looking at impact, meaning that it's not only how ESG factors are financially impacting a company, right? So that's the ESG risks, but then how companies are actually impacting the environment and society. So obviously you are well versed into the framework of the UN Sustainable Development Goals, right? Again, that was referred in the previous presentation. But if you look at Tesla in terms of the UN SDGs, yes, Tesla is well aligned with a number of goals, right? But again, right, the flip side is if you look again on impact and if you look at controversies that surround Tesla, here again, right, I did mention about labor management practices, for instance, right? So that's something that investors may want to consider. So again, right, it's just highlighting the complexity of what we mean by ESG and that it may mean different things depending on who you're speaking to and who the investor's strategy really is, right? But if we focus on ESG as a risk, right, so there's been many studies, but we've done a meta-study a couple of years ago called ESG Foundations of Investing that I would recommend you to have a look at. It's a quantitative analysis in terms of looking at 12 years of history. And what that study highlights is that basically there is a correlation with financial performance, meaning that companies that do get higher MSCI ESG ratings tend to see higher profitability. Likewise, the companies with the lower ESG ratings tend to have a greater exposure to drawdowns over time, right? And it's all good to talk about the theory, right? But you actually have real-life examples with ESG indices, right? So what you have here is the KLD 400, which is a longest living index with 30 years of history. And you can see that it's actually overperforming against its standard benchmark. So obviously you will tell me, but Cedric, look at the slide, look at the dates, it's pretty old. But I would invite you to look at our recent ESG and Climate Index Performance blog. And actually that's something that we also highlight in this blog, where you do continue to see that correlation between higher ESG ratings as a risk, again, right, very important. We're not talking about exclusion, but we're talking about here about risks and overperformance. I will go very quickly because that becomes quite technical, but I wanted to show you also that we also looked at if there is a particular factors that drive the performance. It turns out that it's not. It's really an overall ESG ratings. It's kind of common sense, but obviously, right, when you're looking at a company, depending on the sector in which the company is sitting, they will be facing different ESG risk issues. So it's really a combination of the environmental, the social, and the governance factor that drives that correlation. And then finally, right, it's not just about the absolute ratings, but it's also about how a company is improving its rating, meaning the momentum of the rating has a greater correlation to financial performance. So that's on the ESG side, but on the climate side, so there's been also a lot of report on this, notably from the Task Force on Climate-Related Financial Disclosure, TCFD, also from a research body called the IPCC, right, which really highlighted that companies will be facing a greater financial risk linked to climate change, both on the physical side, right? So here we're talking about an impact of close to $69 trillion coming from a world reaching above 2-degree warming. And then likewise in terms of transition risks, right? I think a report that IPCC published last year mentioned that countries in this region in South Asia may actually be negatively impacted by the likes of 20 to 30% of their GDP, right? So quite important. And again, right, to highlight the complexity and to highlight and to illustrate what investors are looking at, right? They're looking at different types of metrics when they're looking at climate. So they're looking at both from an impact perspective here again, right, when they measure their carbon footprint. They're also looking at then projections of their carbon footprint, right? So if they have exposure to fossil fuel, what are the potential emissions related to these types of reserves, but also in terms of do they have companies in their portfolio that are aligned with the 2-degree world, the 1.5-degree world, notably using signals that like the implied temperature rise. That's on the impact side, but likewise, just on the impact side. So that's where, notably, they will be looking at whether companies have the right targets in place and whether these are sufficiently stringent. And then on the risk side, so that's where a lot of investors will be looking at climate scenario analysis, both from a transition and physical perspective, but also looking at whether companies are actually gearing towards opportunities, right? So are companies already generating revenue from green activities? Do they actually switch their capex toward green capex? So if I simplify, think about mitigation and adaptation, right? So that's what nowadays investors are looking at between these types of metrics, again, impact and risks. So I talked about the correlation between risk and performance, and now we'll talk about the greater push for transparency, notably first coming from regulators. So again, we mentioned that quite a lot, and that has been mentioned in the previous presentation. But obviously, right, so you're well aware that regulators around the globe are really pushing investors for greater transparency on the ESG criteria of their funds, right? So notably in Thailand, you know that there's a recent regulation looking at TCFD disclosure, but you can see that's a global trend that's really impacting every investors globally, right? That's not just investors. What we're seeing is that so now banks are also facing regulations. So you can see here, it's a busy slide, so bear with me, but basically what it's showing is that you already have a number of countries that are setting up mandatory requirements to integrate climate risks within their processes. You then have a number of other jurisdictions that are looking into setting up these types of regulations. I know that the Bank of Thailand is also actively working on this. And really, what I want to highlight here is that, again, right, what it means is that these banks will eventually need to take into account their exposure to climate risks. They will have to decarbonize their activities, their business. So therefore, that means that it is impacting already their lending activities, right? And we're starting to see really some banks that are taking decisions using ESG and climate criteria, and impacting the interest that they are charging on top of their lending instruments. And it's not just banks, if I continue, but it's also insurances. Insurances likewise are being exposed to climate regulations. They're also setting up some net zero targets. So likewise, right, it's not just integrating this into their investment process, but now we are working with insurances that are integrating ESG and climate within their underwriting business, which means that here again, right, you will have insurers, that are making decisions of insuring or not based on ESG and climate, right? So we're starting to see already some insurers that decide not to insure certain types of assets because of their exposure to climate risks. And we're starting also to see insurers that are increasing their premiums, again, looking at the types of risks that these types of assets or companies are exposed to. And so you will tell me, it's great, Cedric, but it's all generally for public companies and the rest we don't care. Well, in fact, it's not longer the case. There's a greater focus in private companies. In fact, there's more and more tools available that enable investors to look at their climate risk exposure, notably in private assets. And what we found out through some analysis is that actually a large portion of carbon risk sits within that private side of the portfolio, right? And so we're really starting to see the shift towards greater focus from investors, from regulators into, again, private assets, right? And so don't think that it's just public companies. And then lastly, where I wanted to finish is that's also something that has been highlighted by a previous presentation, but greater transparency, greater focus is also placed on new types of issues, notably biodiversity, right? So you start to see new frameworks being put in place. So the Task Force on Nature-Related Financial Disclosure, or TNFD, right? I'm sure you're quite familiar with this. But this framework, which will be published very soon, will be setting up the types of metrics that are required in order to measure biodiversity. You already start to see collaborations among the investors that are working together, right, in terms of engagement with a number of their assets. You start to see also the EU, right, and regulators that are looking at this issue. Again, that's something that was mentioned in earlier presentation, but notably in terms of the deforestation-free products regulation that the EU just published, right? And then finally, again, something that has been mentioned with pictures from one of the Thai beach, but it's also because the impact is are getting more visible, right? So if you think of deforestation, wildfires, pollutions, etc., right? And so what we're starting to see is, again, more focus, more demand in terms of data, more demand in terms of disclosure, right? So if I summarize quickly, right, why ESG matters for future of investing, well, the ESG risks are still relevant in terms of financial performance. You have regulators pushing for more transparency for investors, banks, and insurers that therefore are making decisions to invest, lend, or insure based on the ESG and climate criteria. That's not just public assets, but also impacting private assets, and so go through all of the supply chain, right? And then new topics are emerging, and so in fact we're not just talking about ESG risks any longer, but we're talking about impact, we're talking about biodiversity, so it's in fact becoming even more complex. So I hope that was of interest, but I thanks a lot for your time and would welcome any question.
Thank you so much, Cedric. So for the Q&A, I have received a couple of questions. Let me start with the first one. The first one is, how do you see the rise of investors' interest in the ESG assessment of Thai companies?
Good question. So I think it may probably depend on the sector, right? But what we're seeing is just the broader trend in terms of global investors focusing in emerging markets and notably in companies that are operating and sitting in this part of the world, right? So I realize I'm not just talking about Thailand. But I think there's twofold, right? There's first a focus in terms of climate risks, right? The reality is, again, so some reports are predicting that this part of the world would be greatly impacted notably by physical risks, right? So there's a greater focus by investors on how companies that are operating, not just headquartered, but really operating, and also their supply chain operating in this part of the world, are therefore preparing for climate risk, again, in terms of adaptations, in terms of mitigations. And then it's also in terms of new topics like biodiversity, right? So we're starting to see a lot of interest from investors on these topics, right? Greater demands for new types of data, right? And so obviously that's impacting corporates because, you know, if investors are asking for more data, the regulator as well, that means that there needs to be more metrics being reported and available. I hope that helps.
Yes, thank you. The next question is, if we do not have sufficient motivation from regulations or legal penalties, how can we promote or drive ESG in the individual sector?
So it's the carrot and the stick, right? That's how I summarize this. So it's always good to have the stick, obviously, with the regulators that are going to tell you, watch out, right? You need to look into this. So again, there's twofold, and it depends what you define as sustainability and ESG, right? And especially, I think, when you start to reach out into the retail markets. And that leads also to greater transparency, that leads to better discussion and better understanding. But again, right, I think the carrot is twofold, right? First of all, again, ESG as a risk is leads to performance, right? So there is quite a big carrot there. And then secondly, right, when we're speaking to retail investors or wealth managers and distributors into the retail space, right, what they like around the topics of sustainability is greater personalization, right? So being able to personalize product for their clients, whether they're interested into impact, whether they're interested into something that is more linked to their own views, that could be a faith-based investing, etc., etc. So for me, that would be the carrot.
Another interesting question, how does MSCI investigate to prevent greenwashing?
Very good question. So again, right, we're not here really we're not here to advise, right? But I guess there's two things. So greenwashing, first of all, is that we're here to support investors in terms of providing them the right tools to report. Secondly is like when we analyze companies, right? So one part of our assessments is obviously looking at the policies and programs that they have in place to manage some types of risks, right? So if I pick my water stress as an example, we would be looking at the types of programs and policies that the company has to manage these risks. Obviously, though, what we take into account is whether that company in question has the right targets in place, whether these are stringent compared to its peers, and then the performance against these targets, right? It's all good to talk, but are they walking the talk, right?
There remain like several questions, but I believe that you have left us with the contact details, so probably we could, follow up on the questions later on. Thank you so much.
Excellent. Thank you, Kapinka.